The trading floor of Lehman Brothers was still lit on the morning of September 15, 2008. People arrived for work. Some carried coffee. The building had not yet understood what it had become. By noon, the largest bankruptcy in American history would be filed. But that morning felt ordinary. This is often described as the moment the financial crisis began. It wasn't. The crisis had been running for years, quietly, systematically, in full view. What happened in 2008 was not an accident. Accidents require surprise. They require the absence of warning. This had warnings. The collapse was not caused by a single decision or a rogue trader. It was not the result of unforeseen complexity. It was the result of a system designed to absorb profit and distribute risk. And when the risk came due, the system performed exactly as built. At the time, this felt like progress, innovation, the natural evolution of markets. Almost no one questioned it. A conference room in Lower Manhattan, 1999. The economy had survived the dot-com bubble. Growth had resumed. Unemployment was falling. The Federal Reserve, under Alan Greenspan, spoke of a great moderation. Volatility, they said, had been tamed. Recessions were shallow. Expansions were long. The belief was not irrational. It was supported by data. 2 decades of relative stability. Mathematical models that claimed to predict risk. Home ownership was rising. It was policy. It was aspiration. The American dream reinvigorated. Banks offered mortgages to people who had been excluded before. This was celebrated. Expansion of access, democratization of wealth. Public confidence in financial institutions reached generational highs. These were not faceless entities. They were Merrill Lynch, Citigroup, Goldman Sachs. They had survived wars, depressions. They had become synonymous with American prosperity. The ticker tape ran green across cable news. Retirement accounts swelled. Ordinary people checked their balances and felt secure. There was a shared sense that risk had been mathematically defeated, that markets left to self-regulate would self-correct, that the adults were in the room. Financial innovation was treated as technological progress. Securitization, derivatives, credit default swaps. These were tools. Complex, yes, but complexity was not danger. It was sophistication. The regulatory framework had been built in the 1930s, after the last collapse. It felt ancient, restrictive, incompatible with modern finance. There was pressure to modernize, not from conspirators, from economists, policymakers, people who believed the system had outgrown its constraints. The world before the crisis was not reckless, it was confident. And confidence, when shared widely enough, becomes indistinguishable from fact. A banker's office in Midtown, early 2000s. On the wall, a chart showing U.S. housing prices. 60 years of data. One consistent line, up. There had been regional dips. Texas in the 1980s, California in the early 1990s, but never a national decline, not since the Great Depression. This was not speculation, it was history. The assumption was simple. Housing prices could not fall nationally, not all at once, not in a diversified modern economy. This belief was not held by amateurs. It was embedded in institutional thinking. The Federal Reserve used it in stress tests. Rating agencies used it in models. Investment banks used it to justify leverage. If housing prices could not fall, then mortgage-backed securities were safe. And if mortgage-backed securities were safe, they could be layered, repackaged, sold as AAA-rated bonds to pension funds, to foreign governments, to anyone seeking yield. Risk, they said, had been dispersed, spread so thin across so many holders that no single failure could matter. Diversification had become a kind of faith. Academic models supported this: the Black-Scholes formula, value-at-risk calculations, Gaussian copulas that reduced human behavior to predictable curves. Wall Street hired physicists, mathematicians, people who spoke in probabilities and standard deviations. The merger was quiet: academic credibility, market incentive, and it produced a regulatory environment that deferred to the models, that assumed the people running the system understood it better than the people overseeing it. Regulatory capture is not always corruption. Sometimes it is just exhaustion, the belief that the market knows best. So the assumption lived, unchallenged, reasonable. Housing prices could not fall nationally, and because everyone believed it, no one prepared for it. The assumption was not hidden in fine print, it was the foundation. Sit with that for a moment. The entire architecture of modern finance rested on a single belief, and the belief had never been tested. The Oval Office, November 1999. President Clinton signed the Gramm-Leach-Bliley Act. It had bipartisan support. The vote was not close. What it did was simple. It repealed Glass-Steagall. Glass-Steagall had been law since 1933. It separated commercial banking from investment banking, deposits from speculation. The reasoning was structural. If a bank holds your savings, it cannot gamble with them. The repeal removed that wall. Citigroup could now be both, a place where ordinary people kept their paychecks and a place that traded derivatives in billion-dollar positions. This was not sold as deregulation. It was sold as modernization, competitiveness. American banks needed scale to compete globally. No one used the word risk. A year later, December 2000, the Commodity Futures Modernization Act slipped into an omnibus bill, passed in the final hours of a lame duck session. What it did was exempt derivatives from regulation: credit default swaps, collateralized debt obligations. These instruments could now be traded privately, without oversight, without reserve requirements. The logic was efficiency. Regulation would stifle innovation. The market would self-police. Senator Phil Gramm called it a deregulatory bill. He was proud of it. Then, 2004, a conference room at the Securities and Exchange Commission. 5 commissioners voted unanimously. They changed the net capital rule. Investment banks had been required to hold reserves, a cushion against losses. The rule limited leverage to about 12 to 1. The change removed that limit. Goldman Sachs, Lehman Brothers, Bear Stearns, Merrill Lynch, and Morgan Stanley, the 5 largest investment banks, they could now leverage 30 to 1. Some went higher. For every dollar they held, they could borrow 30 or 40. If their bets won, the profits were extraordinary. If their bets lost, the losses were catastrophic. But the bets were not random. Mortgage-backed securities. Here is how it worked. A bank originates a mortgage, sells it to an investment bank. The investment bank bundles thousands of mortgages together, slices them into tranches, and sells them as bonds. The bank that originated the mortgage no longer holds the risk. It has been passed along. This was called the originate-to-distribute model. It severed accountability. If you loan money and keep the loan, you care if it gets repaid. If you loan money and sell the loan immediately, you care only that it sells. Incentives shifted. Loan officers were paid per loan closed, not per loan repaid. And the buyers of these bundled mortgages? They relied on ratings. Moody's, Standard & Poor's, Fitch. They stamped AAA on securities backed by subprime mortgages, the highest possible rating, safer than corporate bonds, as safe as U.S. Treasuries. The rating agencies were paid by the investment banks. the same banks packaging the securities. No one called this a conflict of interest. It was how the industry worked. Then came the insurance, credit default swaps, a financial instrument that functioned like insurance. If a mortgage-backed security failed, the swap paid out. AIG sold these by the billions. It collected premiums. It never set aside reserves, because housing prices could not fall nationally, and if they couldn't fall, the swaps would never pay out. So, why hold reserves? The decisions were not made in shadow. They were policy, law, institutional practice. They were defended by economists, celebrated by markets, and they were irreversible. By 2006, the machine was running at full speed. A mortgage broker's desk in Southern California, 2004. The applications were thin. No tax returns, no pay stubs, no verification. They were called Nina loans, no income, no assets, or Ninja, no income, no job, no assets. The term was used openly, without irony. A borrower walked in, stated their income, signed, walked out with a loan for $500,000. Sometimes the loan was larger than the value of the house, 105% financing, 110%. The borrower could take cash out immediately. Adjustable rate mortgages reset after 2 years. The initial rate was low, affordable. The reset rate was not. It didn't matter. The plan was not to pay the mortgage. The plan was to refinance. Housing prices were rising. Equity would cover it. And if the borrower couldn't pay, foreclose, sell the house at a profit. No loss. This was not predatory in the legal sense. It was simply how the market worked. Subprime origination doubled between 2003 and 2005, then doubled again. By 2006, subprime mortgages represented 20% of all new loans. A ratings agency office in New York, same year. The models were running, algorithms assessing risk. They gave AAA ratings to securities backed by Ninja loans. The reasoning was mathematical. Even if some loans defaulted, the diversity of the pool would absorb it, and housing prices would not fall. The model did not include that scenario. It was not considered possible. Jackson Hole, Wyoming, August 2005. An economic symposium hosted by the Federal Reserve. Raghuram Rajan, chief economist of the IMF, presented a paper. It warned of growing systemic risk, incentive structures that rewarded short-term profit, financial innovation that concentrated risk rather than dispersing it. He was politely dismissed, called a Cassandra, accused of nostalgia for old regulations. Larry Summers, former Treasury Secretary, said the warnings were slightly Luddite. A year earlier, a hedge fund manager named Michael Burry began analyzing mortgage data. He found that default rates were rising, quietly, in specific tranches. He bet against the market, bought credit default swaps on mortgage-backed securities. His investors thought he was insane. And in 1998, years before the crisis, there had been Brooksley Born, chair of the Commodity Futures Trading Commission. She had proposed regulating derivatives, transparently, with reserve requirements. Alan Greenspan opposed her. Robert Rubin opposed her. Larry Summers opposed her. She was removed from influence. The proposal died. New Century Financial, one of the largest subprime lenders, filed for bankruptcy in April 2007. The stock market barely noticed. These were not dramatic moments. They were quiet, easy to ignore. The cracks were visible. They were simply not believed. A Bloomberg terminal in a trading room, June 2007. 2 hedge funds managed by Bear Stearns collapsed. They had been heavily leveraged, loaded with subprime mortgage securities. The funds were not small. Together, they managed $20 billion. Bear Stearns tried to contain it, injected $3.2 billion in emergency capital. It was not enough. The funds filed for bankruptcy in July. Counterparties began asking questions. If Bear Stearns couldn't value its own holdings, who could? 1 month later, August 9, 2007, BNP Paribas, one of Europe's largest banks, froze withdrawals from 3 of its funds. The reason given was simple: the complete evaporation of liquidity in certain market segments. They could not price the asset. If you cannot price an asset, it has no value. If you cannot sell it, it has no value. The European Central Bank injected 95 billion euros into the banking system, emergency liquidity. It was the largest intervention since September 11, 2001. September 2007. Northern Rock, a British bank, experienced the first bank run in the United Kingdom in 150 years. Customers lined up outside branches. The images were broadcast globally. The Bank of England stepped in, guaranteed deposits, nationalized the bank months later. The contagion was no longer theoretical. March 16, 2008. Bear Stearns, the 5th largest investment bank in the United States, was sold to J.P. Morgan Chase, $2 per share. Days earlier, $30. Months earlier, $170. The sale was not voluntary. The Federal Reserve orchestrated it, provided $29 billion in guarantees. Bear Stearns had been leveraged 35 to 1. When confidence disappeared, so did the bank. The assumption had been that Bear was too interconnected to fail. It failed anyway. But the intervention sent a message: the government would step in. That message was tested 6 months later. September 7, 2008. Fannie Mae and Freddie Mac, the 2 government-sponsored enterprises that owned or guaranteed half of all U.S. mortgages, were placed into conservatorship. The government took control, injected billions. The entities had been private, profitable, publicly traded. They were now wards of the state. Lehman Brothers was next. Its stock was collapsing. Counterparties were pulling back. Credit lines were drying up. The government had saved Bear Stearns. It had saved Fannie and Freddie. Lehman assumed it would be saved too. It was not. September 15, 2008. Lehman Brothers filed for bankruptcy. $613 billion in assets, the largest bankruptcy in American history. The next day, September 16th, AIG, the largest insurance company in the world, was hours from collapse. It had sold credit default swaps without reserves. The swaps were paying out. AIG did not have the money. The Federal Reserve provided $85 billion. It was not a loan. It was a takeover. The government now owned 80% of AIG. Money market funds began breaking the buck, falling below $1 per share. The commercial paper market froze. Companies could not borrow to meet payroll. The entire system was seizing, not because of one failure, because of interconnection. Every institution was exposed to every other institution. When one fell, the weight shifted. Lehman owed money to AIG. AIG owed money to Goldman Sachs. Goldman Sachs owed money to Morgan Stanley. The chain had no end, and the system reacted faster than humans could intervene. Automated trading, margin calls, algorithmic responses. By the time regulators understood the scope, the cascade was already running. The unraveling was not chaotic, it was mechanical. A hearing room in Washington, D.C., September 2008. Hank Paulson, Treasury Secretary, stood before Congress. Former CEO of Goldman Sachs, a man who had spent decades in finance. He asked for $700 billion. The request was not detailed. No clear plan for how the money would be used, just the number and the urgency. Ben Bernanke sat beside him, chairman of the Federal Reserve, an academic who had studied the Great Depression his entire career. He said something that members of Congress would repeat for years. If we don't do this, we may not have an economy on Monday. Not a recession, not a downturn, no economy. The words were not hyperbole. There is a story, perhaps apocryphal, that Paulson knelt before Nancy Pelosi, asked her to support the bill. Whether it happened or not, it circulated because it felt true. The Troubled Asset Relief Program, TARP. $700 billion to purchase toxic assets, to inject capital into failing banks, to prevent total collapse. The first vote failed. The stock market dropped 700 points in minutes. The bill passed 4 days later. This was the moment of realization, not for the public, for the people running the system. They understood, finally, that the entire banking system was insolvent. Not one bank, not a few bad actors, the system. Lehman had been allowed to fail as a test, to send a message about moral hazard, to prove the government would not save everyone. The test failed, because Lehman was not isolated. It was a node in a network. When it collapsed, the network collapsed. Credit markets froze globally. Lending stopped, not because banks didn't want to lend, because they didn't know who was solvent. If you cannot trust the institution across from you, you do not lend. And if no one lends, the economy stops. Factories, payrolls, supply chains, everything runs on credit. By the time Congress passed TARP, the damage was done. The intervention was not prevention, it was triage. The people in that hearing room were not villains. They were people who had believed in the system, and the system had betrayed that belief, not through malice, through design. The crisis was not an accident. It was the logical outcome of every decision made over the previous decade. Deregulation, leverage, securitization, ratings, derivatives, each one rational in isolation, each one catastrophic in combination. By the time the problem was acknowledged, control was already lost. There was no villain to arrest, no single person to blame, only the architecture. A foreclosure notice on a door in Las Vegas, 2009. The family had left weeks earlier. The house was empty. The lawn was dead. There were 10 million of these. 10 million foreclosures between 2007 and 2010. Not investment properties, primary residences. People lost the homes they lived in. The unemployment rate peaked at 10%. Official numbers. The real number, including those who stopped looking, was higher. 8.7 million jobs disappeared. Median household wealth fell by nearly 40%. Wealth built over generations. Retirement accounts, home equity, gone. The damage was not evenly distributed. Black and Latino households lost more than half their wealth. Subprime lenders had targeted these communities deliberately. Higher fees, higher rates. The recovery would take years. For some, it never came. A boardroom in Manhattan, same year. The banks that had been bailed out were reporting profits. Goldman Sachs, JP Morgan Chase, Morgan Stanley. They survived, not because they were prudent, because they were systemically important, too big to fail. The bailout funds were repaid with interest. The government made money on the transaction. This fact was repeated often. What was not repeated was who paid the cost. Taxpayers funded the bailout. Homeowners absorbed the foreclosures. Workers absorbed the unemployment. The institutions were made whole. And the executives? No major Wall Street CEO was criminally prosecuted, not one. Civil penalties were imposed, fines were paid, settlements were reached, but no one went to jail. The legal argument was consistent. Recklessness is not fraud. Poor judgment is not criminal. It was true, legally. But it left a question unanswered. If the system nearly destroyed the global economy and no one broke the law, what does that say about the law? Bonuses were paid in 2009 at banks that had received bailout funds. The public was told these were contractual obligations, retention payments to keep talent. The anger was real. Protests, Occupy Wall Street. But the anger changed nothing. In 2010, Congress passed the Dodd-Frank Act, 2,300 pages of financial reform. It created the Consumer Financial Protection Bureau, imposed stress tests on large banks, required higher capital reserves, restricted proprietary trading. It was the most significant financial regulation since the 1930s. By 2018, significant portions had been repealed or weakened. The banks lobbied, argued the rules were too restrictive, stifled growth. Congress agreed. What permanently changed was not the system, it was trust. An entire generation watched the wealthiest institutions fail, get rescued, and continue, while their parents lost homes. The wealth gap that opened during the crisis never closed, it widened. Those who owned assets during the recovery grew wealthier. Those who did not, did not. The recovery was not shared. A kitchen table in Ohio, 2015. A family reviewing bills, still renting, unable to save for a down payment. The crisis had passed, officially. The economy had recovered, officially. But recovery is not evenly distributed. Some absorbed the damage. Some walked away. The distinction was never about virtue. It was about size. The New York Stock Exchange, 2024. The banks are larger now than they were in 2008. J.P. Morgan Chase, Bank of America, Wells Fargo. The consolidation that followed the crisis did not break them up. It made them bigger. Too big to fail became bigger and more certain. The derivatives market is still opaque, traded privately, lightly regulated. Credit default swaps still exist. The notional value is in the trillions. The models have been updated. Stress tests are more rigorous. But the incentive structures remain. Executives are still compensated with stock options, short-term performance, quarterly earnings. Loan officers are still paid per loan closed. Rating agencies are still paid by the entities they rate. The Volcker Rule, which restricted proprietary trading, has been softened. Banks can once again trade with their own capital, in certain market segments, under certain conditions. The conditions are complex. The enforcement is inconsistent. The lesson learned was not about prevention. It was about bailouts. The system now knows it will be rescued. That knowledge changes behavior. If you know the government will intervene, risk becomes cheaper. Moral hazard was supposed to be the reason Lehman failed, to prove no one was too big to fail. But everyone after Lehman was saved. So the lesson absorbed was the opposite. Be big enough, be connected enough, and you will not be allowed to collapse. The machinery still runs. People still take out mortgages. Banks still securitize them. Investors still buy the bonds. The system still requires belief. Belief that housing prices will rise, that counterparties are solvent, that risk is being managed. And when belief falters, the cycle begins again. There is a question that remains unanswered. Was 2008 incompetence or inevitability? Were the people running the system ignorant of the risk? Or was the risk simply profitable enough to ignore? The answer is uncomfortable. because it suggests that the collapse was not a failure of the system. It was the system functioning as designed, absorbing profit, distributing risk, and when the risk came due, transferring the cost. The people who built the architecture walked away. The people who lived inside it did not. This is not a story with a resolution. The structures that caused the crisis were not dismantled. They were reinforced. And the next time, if there is a next time, the question will not be whether it could have been prevented. It will be whether anyone chose to. The vault is still open. The ledger is still running. And somewhere in a boardroom no one is watching, the same decisions are being made again. Not because the lesson was forgotten, because the lesson was never learned. You've just followed one decision beyond its moment. The system moved on quietly. The consequences took longer. If you value calm analysis and stories that look beneath the surface, subscribe to Beyond the Decision, because the choice is rarely the end of the story.